Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Dave Mazza, Chief Strategy Officer at Roundhill Investments. We are talking about two new, very unique ETFs that provide concentrated exposure to the biggest banks and biggest tech companies in the US. Dave, welcome back. Thanks for joining us today.
Thanks for having me back. I'm excited to be here.
So let's talk about big bank earnings, or these big banks reported in the past few days, and their results suggest that these banks, the largest banks in the country, they are doing quite well, despite the recent banking turmoil, and they have actually benefited from the turmoil, and they also profited from higher rates as the Fed has been raising rates aggressively. They have been charging higher rates on loans without increasing the rates that they pay to depositors. And of course, they gained from migration of deposits from smaller banks to larger banks in the wake of the banking turmoil. So tell us about your key takeaways from these recent results.
Yeah, it's fascinating to me. In a quarter where we actually had three smaller financial institutions collapse in some way, the nation's largest banks were able to, on average, generate a significantly strong quarter with robust revenues and earnings. And a lot of this, I think, comes down to the fact that the issues that we first saw emerge with smaller banks, and in some cases has not gone away, in particularly uninsured deposits, questions about commercial real estate loans, and simply put, the potential for mark-to-market losses on bond portfolios, which most banks have, is remarkable. And we believe going forward, and one of the reasons why we were excited to bring BIGT to market, which is the Roundhill Big Banks ETF, is for that very reason, is to offer investors a precision tool for them to express their views on big banks without a concern in their portfolio of whether or not there may be non-banks in there, so other financial institutions like insurance companies or smaller lenders.
So you were able to launch the timing perfectly. So we'll talk about the ETF in a bit, but I was interested in your thoughts on whether these kind of results can continue in the coming quarters, because we know that these banks may have to start paying higher interest rates on deposits to keep their customers from taking the business elsewhere. We have noticed that depositors have started withdrawing money from these low-yielding bank accounts, and they have been putting that money into high-yielding products. And there are choices available to depositors now. Money market funds, treasury bills also, they have seen a lot of interest from investors. And on Monday, Apple and Goldman Sachs announced the launch of a new saving account, which offers a 4.15% interest, which is almost the 10 times the average saving rate of about 0.4%. That is according to FDIC data. And also we know that the US consumer has been in good shape so far, but we noticed from the results that consumer loan losses have started rising. So in general, these banks, they put away more reserves for bad loans in the coming quarters in both consumer and commercial loan portfolios, because, the probability of an economic recession has been rising. So what are your thoughts on whether these big banks can continue to do well in the coming quarters?
Well, you raise a good point. So if we take a step back and look at the really big picture, the macro, it's certainly one where cyclicals, in particular banks, which are really at the intersection of the real economy, so one can think about Main Street, and then sort of the financial economy, Wall Street. And there's a truth to what you say. I believe banks are going to need to pay higher rates on their deposits to keep them from fleeing, so that they're stickier. But one of the benefits that the big banks saw is that they were really a safe haven for depositors and investors in this turmoil. So, if we look at Citigroup, which recently reports earnings, that they noted that they saw over 30 billion of inflows starting on March 7th through the end of March, and that's coming from corporations and mid-sized companies. Other banks we have heard anecdotally have seen a significant increase of inflows. JP Morgan noted 50 billion. But they did note that some of those deposits could be less sticky because these are coming from whether it's individuals or corporations who are concerned about the creditworthiness and the health of keeping their hard-earned capital at banks that may not have as diverse of a capital base and as diverse of a product line than what you can find with larger banks. And that's why we believe that for the time being, particularly in this higher interest rate environment, regardless of whether or not the larger banks, like everyone, needs to pay more for the deposits, they're going to remain a beneficiary. There's still too many question marks, particularly about commercial loans, commercial real estate loans, I should say, that haven't been resolved to say, well, now's the time to go start bottom fishing. If you look at the price to book ratio of regional banks, certainly it's more attractive than it was a month ago, but it's not exactly dirt cheap. So again, for the time being, with all the macro issues that are yet to be resolved, we believe that in this market, investors are going to continue to favor the perceived safety of larger institutions, especially when it comes to larger banks.
All good points. Tell us about your ETF, the Big Bank ETF.
So the Big Bank ETF is an ETF that's focused on providing concentrated exposure, so precise exposure, to just 6 companies. And in this case, it's the 6 largest money center banks in the U.S. And going alphabetically, Bank of America, Citigroup, Goldman Sachs, JP Morgan Chase, Morgan Stanley, and Wells Fargo. And the impetus for this was that I've had the benefit of working in the ETF industry for many years now. And there's a lot of great products out there, particularly when it comes to sector and industry investing. But what many of them miss is the precision that ETFs really offered compared to other investment vehicles 20 years ago. And by that, I mean, investors may just want exposure to the largest banks. If you were to purchase another ETF, you'd certainly get exposure to them, but you'd also get exposure to other companies that you may not want, whether they're insurance companies. In some cases, you might still find REITs in portfolios, but most definitely you're going to find mid-sized and smaller banks. And there's times where you may want to be in mid-sized and smaller banks, but there's times you may not want to be, which I believe this time is one of those. And the beauty here is that you get all the benefits of an ETF. It's highly liquid, or potential for high liquidity. You most definitely have highly concentrated exposure. It's tax and cost efficient. And because it's accessible to all investors at 29 basis points, which is actually a lower cost than the majority of industry ETFs in covering financials, you can do so with a relatively low cost.
Yeah, the expense ratio is definitely very reasonable. So I noticed that for providing this exposure, you use equities as well as derivatives. So tell us why the use of derivatives.
Well, that's correct. So the way the portfolio is structured is that there's a combination of individual equities, and then there's total return swaps, which, as you note, is a type of derivative. And really, the idea, the reason for this, which may be new to some investors who are listening, is that it provides a means of a cost-effective way for us to construct a concentrated portfolio. So if you had a larger portfolio with a larger number of names, you may not need to use total return swaps. But I would also note if folks are interested, please visit our website. We have a significant amount of information on these instruments. They're used widely across the industry. They're used widely in certain ETFs. Some that you may not realize use them, and they're a means for us to gain efficient exposure and provide investors with the precision that we believe they're looking for when it comes to investing in a concentrated portfolio of big banks.
Now, let's talk about big tech companies because investors' focus would now shift from big banks to biggest tech companies as they would start reporting in the coming couple of weeks. And all these companies have done very well this year. Meta Platforms is up about 75%. Apple is up about 34%. And the other big tech companies also, Microsoft, Alphabet, and Amazon, are up between 15 and 20% this year after being beaten down last year. And so as these companies are about to report, tell us what you would be looking for in their earnings reports.
Yeah, so you raise a great point. Big tech had been really the leaders of the equity market for some time. Many of the companies took a pretty big hit in 2022 as markets responded to higher inflation and increased interest rates. And then this year, they've really been on a tear. What we're looking for when it comes to earnings, though, are three things. First and foremost, how are margins developing or holding up? And the reason for that is that these companies, famously from a certain CEO noted that this was going to be the year of efficiency. And we're looking for, well, how's that playing out? We believe when it comes to tech, having this idea of being more efficient is going to be a prudent move. But we want to see how that impacts margins. Then secondly, I think it's hard to get away from all the buzz about generative AI. And many of the companies, when we think of big tech, are involved with AI, and particularly now generative AI. And so we're going to be focused on how much are these companies really committing to this? Do they believe it's a material threat? It's clear that Alphabet does, particularly because of what Microsoft has been doing with Bing. So we're looking at especially at those two companies. We know that there's also potential for other companies to be noting this. Things like the Metaverse, of course, with Meta, perhaps the new headset from Apple. We may have some teases about that. But then lastly, we're also looking at cloud growth. That's another area that had been propelling tech earnings really strongly, almost as the cloud has become so ubiquitous, a bit of a utility for individuals and corporations alike. And we're seeing if they're noting that there is material deceleration there, or better yet, potential for improvement, again, as companies respond to a slowing growth environment, but one where the requirements of cloud and cyber only continue to grow.
So do you expect tech rally to continue? Because after their performance so far this year, the valuations don't look so attractive. They look a bit stretched now. And earnings are actually expected to be down compared on a year-over-year basis. So what are your thoughts on the rally, whether that can continue?
Yeah, well, you're absolutely right. So the rally into earnings season has been impressive. I think some of it was simply driven from a bit of a technical point of view, where investors sold those stocks, and many wanted to re-enter them, perhaps at more attractive prices. But at this point, I think it is difficult with clarity to say that some of these names are particularly cheap. And while NVIDIA is not in the big tech basket, really important company when it comes to AI, gaming, the Metaverse, they in particular are trading at a pretty high multiple. But I do think compared to other areas of the market, from a factor perspective, when it comes to tech, I do think bigger is likely going to be better this earnings season. Many of the smaller tech companies again, not that dissimilar to banks, have less diverse business lines, are likely going to be some of the first to see contracts either extended or pulled, and bigger companies may be perceived as just an easier decision to make for CFOs or purchasing managers when it comes to looking at cloud or other services, for example. So I don't think earnings are going to be particularly spectacular for the big tech companies. I don't think many people do, but which is why we're more focused on sort of what guidance begins to look like, as opposed to just what the numbers look like in the rearview mirror this time around.
Right, I agree. Investors would be focusing a lot on the guidance. Please tell us about your big tech ETF.
So the big tech ETF is structured in a very similar way to its sister, Big B. But what's a bit unique about the big tech ETF is it's really the first ETF, and I'm actually surprised by this, the first ETF that provides exposure to only the 5 FANGM stocks. And of course, we know the term FANG has been around for some time and it's morphed. I think many have coalesced around FANGM right now. Other people call it MAGMA. But really what it is, it's Apple, it's Microsoft, it's Alphabet, Amazon, and Meta. And again, this is an area where you can get access to these companies, and I'll pick on Apple for a minute, probably in nearly every ETF. I'm being a bit facetious, of course, but the company is so important and is involved in so many different technologies that you tend to find it in many areas. The same can probably be said about the other 4 names. But what's important here is that this ETF at 29 basis points is providing exposure to just these names. And again, they are leaders of their industries. They, at this point, because of changes made to sector classifications, are in a variety of different sectors and industries than they did historically. And Big T solves that problem. It provides that precision that we believe investors are likely going to be looking for when it comes to potentially allocating toward tech going forward.
So do you think this basket would remain unchanged, or do you plan to include NVIDIA or say Tesla, which is not exactly a tech company, just classified as a consumer discretionary stocks, but it's actually seen as a technology company. So is this basket going to change or evolve, or would it remain the same exposure to just these 5 stocks forever?
Well, I think that's a really interesting question, because how tech is defined could change. How banks is defined, probably less so. But the idea here is that the bar for changing the constituents will likely be high, and it will remain high going forward. So we're not just going to put Tesla in the Big T portfolio if Tesla's rallying or what have you. This is about providing a precision tool, and for the time being, regardless of how some might classify. I think a manufacturer of automobiles is not a tech company in the way that one could say Alphabet and Meta are, even if they are now classified as communication services. So we do not plan to be tweaking the portfolio in a truly active fashion that is putting in and putting out names depending upon performance. This is about an identification of what are the big tech companies, what is generally a belief in the market that the big tech companies are, and today that's really the FANGM stocks.
And I understand that you have some more products in the pipeline for your big family. Please tell us about the products that you would be launching in the coming months.
Yeah, so we have a wide variety of filings out there when it comes to the big concept, again, which is focused on a portfolio of somewhere around 5 or 5 names to provide precision to certain industries. And 2 that we hope to have coming soon are Big A, which is focused on the big airlines, and then Big D, which is focused on the large defense companies. of course, like I said, we have a few other filings out there. There's only so much anyone can say about new ETFs that may be coming, but we're excited about the potential for these portfolios, and from what we've seen thus far, how folks, both as a trading tool and as an investment tool, are coming to Big B and Big T.
Switching gears a little bit, I also wanted to talk about your Metaverse ETF, which is your largest product. And this was the first Metaverse ETF. And in fact, we had Matthew Ball on the show then after its launch. And we have seen that investors have lost interest in the Metaverse. And in fact, some of the Metaverse's most ardent supporters are also scaling back. Zuckerberg, Meta's CEO, and you alluded to that he declared 2023 as the year of efficiency. He has now been talking more about artificial intelligence in his recent earnings calls. But as far as Metaverse ETF launches are concerned, in the ETF universe, it still remains a very hot theme. After your Metaverse ETF, we have seen a number of Metaverse ETF launches. Though they have failed to gather assets, yours had the first mover advantage, and that still has about, I think, 500 or so million in assets. So tell us about the Metaverse ETFs. What do you see for them in the coming months?
Yeah, so we continue to be a big believer in the long-term potential of the Metaverse, and in that it becomes both a successor to how we think about the internet today, and really the ability to have experiences that span the real world and the virtual world. And of course, a company like Roblox and what's happening with the transformation at Meta are great examples of this. Now, we did see some enthusiasm for investing in the Metaverse decline in the last year, particularly because many of these companies are high growth companies, and in a rising interest rate environment, they are likely to struggle. But what I've been very happy to see is investors are beginning to separate what's really just a fleeting theme, right? What may have just had kind of short-term firepower versus what's real and what's long-term. And the Metaverse is one of those. And you raise a great point. We're now hearing a lot about AI, and we're excited about AI, but they don't necessarily have to be mutually exclusive, right? The idea of artificial intelligence will play a role in the Metaverse. Generative AI will likely play a role in the Metaverse as well. So the transition to the Metaverse remains the case. I think it's healthy that we're beginning to see a rationalization of aggressive spending. And interestingly enough, if we look at METV, it's actually one of the top 25 performing ETFs across the entirety of the U.S. ETF market in 2023. So even though it did struggle in 2022, investors are perhaps re-looking at the space and rewarding companies accordingly for beginning to take a bit more of a scalpel to their earnings and a scalpel to their growth plans so that they can be in the best position going forward.
Right. I did notice the performance. It is one of the best performing ETFs this year, and Meta Platforms is up more than 75%, as I mentioned. That's all we have time for today. Dave, thank you again for being with us.
Thank you for having me.
That was Dave Mazza from Roundhill. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Please also make sure to subscribe so that you do not miss any episode. If you have any questions, comments, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.